The following is a presentation of TFNN.
Good day, Money Masters and Treasure Hunters. Welcome to the 4th of July edition of the Tom O'Brien Show. I'm your guest host, Steve Rhodes, filling in for Tom. And from all of us here at TFNN, we want to wish you and your family a safe, happy, and healthy 4th of July celebration. Make it a great one, folks. If you're not familiar with me, I kick things off here at TFNN each morning at 9 o'clock for the first 2 hours of the trading day. It's a real honor, a real privilege for me to be able to call the markets for you each day. If you haven't checked out that show, all the archives are on Channel 9. But tune in. You can always tune in via your mobile device at tfnn.mobi if we're not on a radio station in your area. I teach you all kinds of tools out there. We'll do that here during this show. We'll take a look at that lightning bolt pattern, the A to B equals CD. We'll take a look at Fibonacci, expansion and contraction, all kinds of stuff. We'll take a look at candlestick charting, the real message of the markets out there. I'm also author of a very, very comprehensive daily newsletter service called Mastering Probability. It's out each morning by 8 o'clock, and for the first time ever here at TFNN, we're offering this service to you for a 2-week free trial. Whether or not you have used the service in the past, that means 2 weeks, no charge to your credit card for an incredible education and a system for being able to make money. It's an important time for you to go ahead and download that newsletter, get access to that newsletter. We're building some positions here, some changes in the marketplace. You want to make sure that you're taking advantage of it. May even be some trades here this afternoon coming in at about the 12:45 time frame out there. So if you are listening and this show is being taped here and replayed, look, if you're listening to the replayed show, you still want to go over to the homepage at tfnn.com and take advantage of this newsletter service. This offer is limited. It'll be gone by the end of the 4th of July weekend celebration. I'm also author of a new special report here at TFNN called The Trend is Your Friend Until It Changes. You can download that over for free on the homepage of tfnn.com over on the left-hand side. Folks, and I mean this from the bottom of my heart, the center of my heart, the top of my heart, I absolutely treasure your presence here today. My outcome, as always, is to help you to become a better money master, but mostly to provide you with tools that each of us need in order to lead an inspired life. Because leading an inspired life, folks, that is what it's all about. So, let's go look at one of our tools. This is the tool I call declaring our independence. You know, the 4th of July celebration, rooted deep in history. It's recorded that shortly after the Declaration of Independence was signed in Philadelphia, celebrations took place throughout the land, and many of the former colonists were just beginning to call themselves Americans. Yes, we celebrate with fireworks, with picnics, maybe some nice barbecued ribs, fun festivities, but imagine what it must have been like in Independence Hall when 56 men came together to sign that parchment, the Declaration of Independence. You know, it was noted at that time that they pledged their lives, their fortunes, and their sacred honors. And that was more than rhetoric, folks. Much, much more. Each of those men knew that the penalty for high treason to the crown, well, it was their life. We must all hang together, Benjamin Franklin said, or assuredly we will all hang separately. John Hancock, it is said he wrote his signature so large, in such large script, that King George would be able to see it without his spectacles. They were all brave individuals, all brave men. They stayed brave throughout all the bloodshed of the coming years as well. Their courage created a nation built on a universal claim to human dignity, on the proposition that every man, woman, and child had the right to a future of freedom. So for just a moment, let us listen to those words again. They go like this. We hold these truths to be self-evident, that all men are created equal, that we are all endowed by our Creator with certain unalienable rights, that among these are life, liberty, and of course my favorite, the pursuit of happiness. It is my hope that someday, folks, every people, everybody, every nation of this world will know the blessings of liberty. Now, all throughout our history, our presidents, all of our leaders, they've spoken about national unity, and they've warned us that the real obstacle to moving forward the boundaries of freedom, well, they come from within. And it's absolutely true, and it has been ever since the signing of that parchment, of that Declaration of Independence. Why, two of our greatest founding fathers, John Adams and Thomas Jefferson, who worked so closely together in Philadelphia for independence, well, they parted ways not too long after the signing of that declaration. You see, once a government was formed, something called partisan politics. You've heard of that. Well, partisan politics began and set in, and it created a bitter, divisive campaign between Jefferson, who defeated Adams for the presidency back in 1800, the night before Jefferson's inauguration. Adams slipped away to Boston, disappointed, brokenhearted, and bitter. Eventually, years later, 4 or 5 years later, they got back together. But politics, folks, it is divisive. But here is what I do know. I know these things to be true. The things that unite us, America's past, of which you and I, we are so proud, our hopes, our aspirations, for the future of, this great country of ours, that these things far outweigh what little divide us. This weekend, you and I, we must remember that we are one nation under God, one nation indivisible, that regardless of politics, we are all Americans. We must pledge ourselves to each other and to the cause of human freedom, the cause that has given us the light bulbs that go off, everything, every opportunity that we are presented with. So, from all of us here at TFNN, we want to wish you, your family, all your friends, everybody in your life, a happy, a safe 4th of July. Make it a great one, folks. And as we say, let the fireworks begin. We've always got fireworks here in the markets. Right now, we've got the Dow off 31 points. S&P is down 8, trading at 1606. NASDAQ off 9. Trading at 34.23. Russell down 4.5, off 0.4%. The leader in the clubhouse to the downside, and this is key, folks. This is the New York Stock Exchange. It's often overlooked, but it never should be overlooked because this is the wide breadth of the marketplace. It is down right now 0.7%, off 65 points. It was the New York Stock Exchange, quite frankly, that gave us the key reversal signal, not just because it was a key reversal day and a key reversal week during May 22nd out there, but it really gave us our first signal. Right now, we've got a wide breadth of sell-off inside the market amongst the New York Stock Exchange. There are right now 2,263 net decline, not net, but 2,263 declining issues, 540 advancing issues. That means a net number of minus 1716. If you are listening in, and today you see net declining issues coming into the time frame of 1 p.m. when our market closes of anything greater than 1233. What I'm about to tell you as far as where the market should bounce to, all bets are off. That will not happen. We will see the New York Stock Exchange give us our next sell signal in the markets. The internals will be weak out here, and I suppose that means that we will hand the ball off to Asia, which will hand the ball off to Europe, and there is troubles in River City, and that's what we need to be paying attention to. That's the one number that you need to be paying attention to today. Even if the market closes flat or up, you need to take a look at what the net advancing issues are in the New York Stock Exchange. I feel like I'm riding through the streets of Boston, blaring it out here, but you get minus 1233 out there, and that will actually be a sell signal in the marketplace. Let's go take a look at what's going on here. Right now, you've got gold is up $13. Huh? Imagine that. That is that bottom has formed out there. You've got silver up 48 cents. That's up 2.5% this morning. Unfortunately, we've got light sweet crude. That's up about $2 right now, trading out above 101, 101.50 here. Let's start off by taking a look at the S&P 500. Now, what I'm going to do today, I'm going to give you a short term. The short term here is qualified because the short term we're taking a look at the daily. So I'm going to tell you, I just told you what the override switch is here, the kill switch inside this market. And that's going to be net, or in this case here, net declining issues in excess of 1,233 out here. If we get less than that, then here's what the shorter-term outlook looks like. What it looks like is we'll see maybe some kind of a spike, whether it's Friday or Monday, with regard to the S&P 500, trying to get into, I'm going to call it the bottom of the June 19th level, right around 1628. Maybe it's 1628, maybe it's 1635 out there. And that's assuming, again, less than 1,233 net declining issues out there. And if that takes place, and on the short-term aspect, you don't see a bunch of, we've got a little intersection out here, which is a trend line off of the lows from November 16th. You can draw this on your stock chart for sure using the S&P 500. You can use your touch point of November 16th. The next touch point would be December the 31st out there, and that's to the upside. Now what you can use as a descending trend line from the top, you can use the top of May 22nd. That's what I've got out here. Your next touch point is going to be the high of June 18th, where it set up that nice Gartley sell pattern. That's where my clients and I, we went ahead and went short the market at that top, and now we're taking a look at where's that going to intersect price-wise. You know, it would probably be right around the 1633-ish level. What we're going to do is so bearish, so I am short-term bearish. Of course, I'm waiting right now for a sell signal, and if the market were to close here right now, my shorts are ironed. I would actually go ahead and put them on. 877-927-6648. We get back, we'll go take a look at the longer-term picture.
Who says you can't take it with you? TFNN says you can. With your mobile device and TFNN's live radio streams, TFNN has put it all in the palm of your hands. No special apps to download. No subscription fees for live radio or Tiger TV streams. We say you can.
Now let's go over to the dollar, because the dollar is going to be the generator. It is the generator of basically higher dollar, lower market. And what the dollar has done, and this whole uptrend, folks, has just gone sideways. The way it works, folks, is this.
We say you can. The Tiger Financial News Network. Smart investors and professional traders know you can. TFNN.com. Educating investors.
Hi, folks. I'm Steve Rhodes with TFNN.com, and the trend is your friend until it changes. A free special report is now available on the homepage of TFNN.com, and if you have money in the markets, this free report is a must. If your strategy is buy and hold, this report is a must. If you're a day trader, a swing trader, a Forex or options trader, or just getting into the markets, this report is a must. And it's the second best gift you'll ever receive. Look, if you buy a stock and the general market is trending in the other direction, you've reduced your odds of buying at the right time by 70%. Instead, let me teach you how to get that 70% advantage plus. The plus is a free trial to my daily newsletter service, Mastering Probability. There's no upfront deposit, no charge to your credit card, and I compress decades of education into each daily newsletter. This is a limited time offer, so act now, and I'll teach you how to take the trend and turn it into your best friend. All the details are on the homepage of TFNN.com. Act now.
With the launch of Tiger TV, TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, David White, Larry Pezzamento, Andy Hecht, Victor Jones, or Daryl Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing. Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen, live during those shows, and have access to all those charts. You can test drive the Tiger's Den, absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads.
Tom takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Welcome back to the Tom O'Brien Show, folks. I'm your guest host, Steve Rhodes, filling in for Tom for our July 4th edition here, and we're going to go right over to the VIX Index and the S&P 500. I hope you're following along and watching us here on Tiger TV. If not, you can go ahead and lay this out on your chart as well. My charting package here that I use, I can go ahead and separate the window into two different charts. Now, on the VIX Index, which is what is at the top of my screen, there's a little blue squiggly line going across it. It's called the 50-day exponential moving average. I want you to put that on your chart as well, or just follow along with me here. Now, the key here is that any uptrend in the market requires the VIX to be underneath the 50-day exponential moving average. So I'm just simply going back to the March 2009 time frame here. We can see, in fact, on March 11th, 2009, we had the VIX go ahead and drop back below the 50-day. The top of that was 49.68, closed out at 40. The close was 44.37, and the 200-day exponential moving average was 47.57. You can see as our market moved up off of the March 9th area, take a look at how, the VIX came up and it tested the 50-day, but it stayed below it. It stayed all the way below it up until the time frame, the real first time that it really got above the 50-day, which was for about 2 trading sessions, was on September 1st, 2009. Each time that we see the VIX move up, you see the and actually get above the 50-day exponential moving average is where you start to see some pullbacks and retracements in the marketplace. But so long as price is under the 50-day, and I'm talking about price of the VIX here, we can see the market move up. Sometimes it's up big, but it just simply moves up. Now I'm going to go ahead and fast forward here, and we're going to take a look at where we're at. Well, let's take a look at right here. How about coming off the lows in July of 2010 out there? As soon as the VIX dropped below it, which was on July 7th, the market went ahead and started moving up. We saw a little bit of a retracement as well between August of 2010 all the way down to August, I should say, really from August 12th or so, 2010, all the way until the time frame of September the 1st. That's where the VIX dropped back below that 50-day exponential moving average. So it's very key to be using that as one of your benchmarks to be taking a look at out here. Take a look at this big, huge downtrend that we went through back in August of 2011. The uptrend began once we saw the VIX get back below the 50-day exponential moving average out there. So it's a really great tool for you to be able to use. So the opinions that I'm giving you here today, I don't necessarily consider them opinions. I consider them just simply reading the chart patterns that exist out here and understanding historically when price moves up or when a market moves up out there. Oh, geez, I hate when that happens. When the market is moving up, what is the relationship between the volatility index out there? It's got a lot of different uses out here, but one of them with regard to the trending of the markets that is key is that a market that's in correction, you are going to see the VIX above the 50-day. If we take a look at where it is right now, you've got the VIX trading out at 1694, and the 50-day EMA is down at 1585 out here. In fact, ever since the VIX got above that level, which, by the way, was May 22nd of 2013, which was the top of our market, which is where the correction began, you can see the VIX above that level. It came back and tested it, no question about it. Did that yesterday as it got down to a low of 1588, but it rejected that area. So what does that mean on the shorter term? It means correction is still in play here, and the larger A to B equals CD down is what we are taking a look at. And again, today you see the New York Stock Exchange with net advancing issues minus 1233 or larger. What you're looking at is an absolute sell signal inside the New York Stock Exchange. Right now, as I speak, the Dow is flat. It's up 38 cents. The S&P is back 5. The NASDAQ is down 10 pennies. The NASDAQ 100 is up 4. The New York Stock Exchange down 50 points. Net declining issues, minus 51. Sell signal in place. However, the trading session is not over, so you got to go take a look at what it is at 12:59 p.m. today. But here, taking a look at the VIX, this is a great tool for you to be able to use to understand what the markets are doing. Are we in any kind of confirmed uptrend or anything along those lines? And here, if you utilize this tool, the answer is unequivocally no. It has nothing to do with my opinion. It's just simply going back and taking a look at the chart patterns that are out there. So that is on more of the shorter term basis. If we also go on the shorter term basis and take a look at the ETF structure, that's the next easiest way to be able to do this. And let's take a look at the S&P 500. If we take a look at the S&P 500, number one, it's in a confirmed downtrend out here. If you've downloaded my special report, The Trend is Your Friend Until It Changes, there's a tool that I share with you on that as well, as far as how to identify reversals or changes in trend. What do we see inside the S&P 500? We've seen volume to the downside. We've seen the completion of an A to B equals CD down. That's off of the May 22nd high down to the low. Your B point was June 6th, and your C point was at June 18th level. And we've seen a little bit more than a 1-to-1 A to B equals CD down. But what we have seen is volume to the downside, light volume to the upside. You can see here the SPY as it attacks the June 20th downdraft, which has 321 million shares, really struggling from a volume perspective, 131 million shares on July 1st, and it rejected that area. Little doji style high wave candle. The same thing yesterday on July 2nd out there, 154 million shares. You're trading a bit lower here today. No volume obviously in it today. There was no volume really yesterday, 154 million shares, but still going against 321. So volume is to the downside. What does this set up? This sets up the larger A to B equals CD down. You're talking about going from the high of May 22nd in the SPYs down to the low of June 24th. Now, it's got some good volume down there, 222 million shares, but I suspect it'll be able to pull that out. Maybe the high came in on July 1st out here, and if, in fact, there was less than, there's more than 1,233 net declining issues, the answer is yes. That was the high that was out there, and now you're taking a look at the 1-to-1 A to B equals CD. We'll take you down to 149.14. To 145.49. I have been calling for a minimum test ever since we came into May 1st of 147.17. That was a 200-day exponential moving average on the S&P, on the SPY out there, same equivalent to the S&P 500. And that's the minimum target range. That is during the 6-month unfavorable seasonal cycle, which is exactly what it is that we are in here right now. So that is what we should expect. And until we see the VIX dip below the 50-day EMA, then we can come back and say, all right, the market is giving us a different message. But the market message right now is very clear. In fact, here, if we take a look at the SPY, what the SPY actually did on June 24th, 222 million shares coming into the swing point from October of 2007, and we're going to take a look at the weekly chart here in a moment. That swing point is very, very important because that was the SPY's breaking out of a long-term consolidation level. But it was coming into that area hot. In fact, the trading session before, 271 million shares. So you're coming back into that swing point. At a minimum, it says the June 24th level will be tested. That area, 155.73. But I suspect what we're really looking at, which is normal, it's not that big of a deal out here just yet, and we'll take a look at that as we take a look at the longer-term charts, is a normal pullback into that 200 exponential moving average that was present on April the 30th. At least that price level is what I should say. Now, we're going to go switch over. We're going to take a look at the ETF structure here. Since we're in the ETF structure now, we're in the daily ETF structure. Let's go over to the weekly ETF structure, and let's go take a look at the SPYs. And we'll take a look at more of this when we come back from our next break. But what I have here, what you're looking at in the SPYs, you're taking a look at the rising price channel coming off of the March 2009 lows. And what we can see here, our target of 148 actually takes the SPY right back down to the bottom of that rising price channel. No real damage other than getting back inside the lower part of the range, meaning the October 2007 area. But I still suspect that'll be just fine. 877-927-6648. We'll be right back, folks.
The Art of Timing the Trade Charts has officially launched at TFNN. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind software, The Art of Timing the Trade Charts allows you to scan for Fibonacci formation setups, including Gartley's, butterflies, ABCs, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the market for stocks just beginning to form the trading patterns that many investors spend days, weeks, and even months searching to find. As part of our introductory pricing, we're offering licenses available at only $59 per month. We're so confident that you'll love this new outstanding piece of charting software that we'll even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Lock in your low price today by ordering your copy at TFNN.com. Tom O'Brien's weekly newsletter, The Gold Report, has helped subscribers for over 10 years navigate the high-risk world of exploring and producing gold companies. And now's a great time to sign up for a free month-long trial to see the kind of insight that Tom delivers for his subscribers on a weekly basis. Every Monday, Tom O'Brien issues a quick update on the metal market, giving you his take on the HUI, XAU, GLD, dollar, bonds, and much more. Tom follows Monday's update with a full gold report, which is delivered to subscribers Tuesday afternoon with detailed coverage of 24 separate gold or metal stocks, as well as another 10 to 15 stocks that he lets you know are on his potential watch list. Get your month-long free trial to the Gold Report today by visiting the front page of TFNN.com. Don't spend another year navigating the metal markets on your own. Act early in 2013 and make the most of your gold and metal market investments.
Patterns, profits, and peace of mind.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's trading newsletter.
Patterns, profits, and peace of mind.
In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the Forex market, and more. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 full weeks. That's an $85 value. Yours free when you register right now.
Get Larry's Patterns, Profits, and Peace of Mind.
And get the edge you've been looking for.
You've always taken the long view when it comes to investing, but what if there's an opportunity right under your nose? What if you could be more responsive to market trends to seek to boost your portfolio performance right now while seeking to reduce your overall risk? At Direction Funds, we connect investors with alternative strategies that seek to maximize their returns. Smart investors deserve smart alternatives. Find yours at directionfunds.com. An investor should consider the investment objectives, risk charges, and expenses of Direction Funds carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Funds. To obtain a prospectus or summary prospectus, please contact the Direction Funds at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. Investing in index funds may be more volatile than investing in broadly diversified funds. Distributed by Rafferty Capital Markets, LLC. McEwen Mining is a high-growth, mid-tier producer in the Americas with a market capitalization of $1 billion. Experienced mining executive Rob McEwen, as chairman, CEO, and president, owns 25% of the outstanding shares of McEwen Mining and has put in place an ambitious business plan with the goal of qualifying for inclusion in the S&P 500 by 2015. With $70 million in cash and liquid assets as of the end of 2012 and completely debt-free, McEwen Mining is poised for growth. Production in 2013 is forecasted to grow at 24%, reaching 130,000 gold equivalent ounces, and over the next 3 years, McEwen Mining projects that their production will increase to 290,000 gold equivalent ounces, almost a 3-fold increase from last year's totals. If you'd like to find out more about McEwen Mining, click on their banner on the front page of TFNN.com or check them out on the NYSE or TSX under the symbol MUX.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Welcome back to the Tom O'Brien Show, folks. I'm your guest host, Steve Rhodes, filling in for this 4th of July special. And as we take a look at the SPY weekly chart, that's where we left off here. What we're looking at is if we take a look at the swing point that it broke out of, that was the October 12, 2007 swing point, 625 million shares up there. The top of that was 157.52. As the SPYs came back, they came back here the week ended June 21st, 1 billion shares. So 1 billion going against 625 625 million. Tested it again last week, 808 million shares out there. It says the lows of 155.73, the low in the SPY. That's going to be tested. But the real target, 148. And at 148, it really brings into play here this rising price channel, which is held. We saw a little bit of a break of it back in September of 2011, as well as September 30th, 2011. And then we got back into it. The SPYs got right back into it October 14th, 2011, and it basically stayed within inside that rising price channel. So that is the target. That's where the SPYs should head to between now and sometime between October 31st during this 6-month unfavorable seasonal cycle. But even with it does that, it will get back into the bottom part of the range, meaning it will have broken a triple top. Because if I pull this back even further, what you will see here is below that below the level of the highs that were put in back in 2000, March 24th, 2000, which is 155.75. What that will do, we will have had a triple top. We will have had a break of a long-term consolidation, and we'll get back inside there. So as long as the rising price channel holds, then, not too much damage, and I think what we will see is we'll see the market continue to move higher. But that's not just based on the SPYs, because we need to go take a look at the other ETF structures. So let's go take a look at the Qs here. Let's take a look at the NDX 100. What has the NDX 100 done off of the lows that came in 2008, meaning 2505? That was your A point. Your B point out here in an A to B equals CD up. That was on April the 30th, out at 5065. About a 0.382 retracement down in July 2nd. A 1 to 1.272, A to B equals CD. Well, that completed at a price level of 74.36. What we actually saw was 74.33 was the close the week of May 17th, a slightly higher high during the week of May 24th, but a close of 73.41. So it completed a 1 to 1.272, A to B equals CD, and now it's pulling back. Now what the Qs will do here, the Qs should pull back into the $67 level. If they pull back into the $67 level, they will go ahead and break this rising price channel that is out here. Maybe it's just a spike down in there, but 67 is basically its target. However, if you take a look at the breakout here, the Qs broke out of that consolidation level way back here in the time frame. The first breakout was in January of 2011. Moved higher, came back into the price channel. In fact, came back into the consolidation range, I should say, and then came back and tested the bottom to really set up that rising price channel during the time period of August of 2011 out there. So there's no way, and well, I don't say no way, in just the normal pullback that I expect during the unfavorable seasonal cycle out here, the Qs are not going to get back into the lower part of its range out here. And the Qs being, technology oriented, they will go ahead and pull the markets higher. So even though the S&P can get back into the bottom portion of its range, I don't see that taking place inside the Qs. Now we're taking a look at a weekly chart out here, so it's more of your longer intermediate term picture that we are looking at. Now let's go take a look at the IWM, the Russell 2000. The Russell 2000 broke out of its consolidation level, taking us back to July of 2007. The high there was 85.74. I expect the pullback that we will see inside the IWM will be into about the $87 area. It's about 10 points lower out there. Notice if it gets to 87, it still is above the consolidation area. In fact, maybe what it does is just simply comes back and tests the consolidation, which is right around 85.74. It could be right up here at the high of May 13th, 2011. That was 85.54. But for it to pull back, test the bottom of its rising price channel, and as well test the top of the consolidation and then take off from there, that would be bullish. That would be bullish on the intermediate term. That would be bullish on the long term. So we're seeing that the IWM would be confirming just even a normal pullback, the pullback that we should expect here during the 6-month unfavorable seasonal cycle, that it does not break, getting back into the lower part of its price channel, or the consolidation range. If it does, that spells trouble out there. It spells big trouble. Now let's go take a look at what the diamonds are going to do, or should do out here. The diamonds, they also completed, or came very close to completing, a 1 to 1.272 A to B equals CD up. That completion point would have been about 157. We saw the diamonds here, the May 22nd, which would be the week of May 24th, get up to a high of 157. 55.14 out there. The expected pullback inside the diamonds now will take us back inside the lower part of its range. What do I mean by that is it'll get back below the October 12th, 2007 high, which is 141.95. My expectation is we'll see a pullback into about the 137 area. That would be the target out here. In this case here, let's say all those happen, you would have the diamonds, which are 30 stocks, getting back inside the lower part of its range. The S&P 500 stocks getting back inside the lower part of its range. But the IWM and the Qs being the real strength inside the index. And right now we know the IWM is certainly the strength inside the index. The Qs broke through that consolidation that consolidation level very early on out there. And I believe that those will be the two that will go ahead and raise the bar and lift the diamonds and the SPYs. And so long as really this price channel here holds, even if you get a close below it and you get back inside the price channel, that's what will give us a longer-term move to the upside. So that is laying out for you the shorter-term picture by using the VIX index and laying that over. You can lay that over the Dow. You can lay that over the S&P 500 out there, and paying attention to the 50-day exponential moving average out here and taking a look at a longer-term picture. And then there's always the more ultra-short-term, and that would be what I consider to be the EKG of the market, and that's by taking a look at the 30-minute futures contract of the ES Mini. And what we are seeing here right now, it has been traveling in a sideways consolidation range ever since the time period of about 10 in the morning or so on June 26 out here. Has not been able to bust through that consolidation range. That sets up a move higher. That move higher could take us back into the 16-20 level, and that's what I suspect will happen so long as the net declining issues here today at the close do not exceed 1233. At 10:42 a.m., they are at minus 1580 out there, and that says that the bulls have fumbled the ball, but not until the trading session closes does it really matter out there. So that is the general market overview. I can tell you that right now, even though our markets are, you got the Dow is positive by 4, S&P is down 3, NASDAQ is up 1. Over in Europe, they're saying, are you guys nuts? Because if we go take a look at the charts around the world here, let's put in those. If we take a look at the DAX and we take a look at the FTSE out here, which are still trading, you've got the DAX down 1 4/10% here. So as we take a look at that, the DAX here is trading inside the swing point from June 24th. Something to think about. So you got the DAX already inside there. It's going to certainly go test its low, and if it busts that area out, which would also be closing below the 200-day exponential moving average, 71.32, 68.86 is really on its horizon out there. If we go take a look at the FTSE nearly at its session lows here right now. It is down a total of 101 points. That's off 1 6/10%. Now, it is not all the way back to the June 24th level. The top of that would be 61.36 out here, but the FTSE has already had a 10% move off of its high from May 22nd out there down to that June 24th low, and it needed to work off its oversold condition out there. That's what it's doing. It's giving you a reversal signal here. This is a evening star pattern that says now you've got some decent resistance up here at about the 63.14 level. Let's go take a peek here at the commodity section out here. We've got gold right now. You've got gold trading up about $10, trading out at $12.53. Gold is formed a bottom. It did a 1 to 1.618. A to B equals CD when it got down to 11.78. We're going to see gold get up to the 13.2150 level real quick. It's at 12.53 right now, so that is no stretch. And if gold gets back inside 13.2150. Well, let's go see what that actually sets up. Let's take a look at an A to B equals CD down, and a retracement, I should say. And let's go all the way back up to the highs of October 4th, 2012, all the way down to lows that came in last Friday. Well, your dead cat bounce gets you to 14.15. A normal retracement would take you to 15.61. So the first area that gold needs to tackle, and it will go tag it. It'll go try to tag that high volume low from April 16th that it broke out of, is 13.2150. If we go take a look at silver, you have a similar setup on silver. And things have not really even gotten going. They will, though, as these two metals start to move up here. We're going to see some vicious short covering rallies in the marketplace because the non-reportable group, the individuals out there, they're at their highest net short position, and they will get twitchy really, really fast. You got silver is on its way up to about the $22 level. $24.78 would be its move if it closes inside $22, and $28.85 after that. 877-927-6648. We'll be right back, folks.
Namaste, Allie Ford here with a special invitation for you to join me on a health and wellness vacation to the Samana Peninsula of the Dominican Republic. I spent a month in this beautiful spot last year with my family and can't wait to get back there. Known as the Jewel of the Dominican, Samana is a remote stretch of coastline nestled behind the highest peaks in all of the Caribbean. You'll have the opportunity to heal your body and mind with morning and evening yoga and meditation and explore Samana. Visit secluded beaches with pristine turquoise water, zip line through the forest, ride horseback to spectacular waterfalls, or simply catch up on much needed rest and relaxation at our hotel, pool, and spa. You'll also have a chance to visit a local school and give back to the community through a special SEVA or service project. Whatever your heart desires, Samana has it all. Book now as only a few spots remain on this amazing adventure. You can do this and find more information on my website, allieford.com. Pack your bags and I'll see you in paradise.
In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Recently, Basil Chapman has had some outstanding trades in his newsletter, The Opening Call. Each morning by 9 a.m., Basil uploads his newsletter to the TFNN servers so that his subscribers can access his expert trading advice. Basil gives his take on the direction of key indices and updates any active trades that his subscribers are currently in. Just recently, Basil subscribers closed out a short position in Chipotle Mexican Grill, CMG, for more than an $86 profit per share, over a 20% gain in just one position. If you'd like to try out Basil Chapman's newsletter, The Opening Call, then visit the front page at TFNN.com and click Trading Newsletters. There you'll find Basil's newsletter, The Opening Call, where you can request a free sample copy. Also, don't miss Basil's program, The Tiger Technicians Hour, Monday through Friday, 11 a.m. Eastern, on TFNN.
With the stock market flirting with all-time highs and volatility back, now is the perfect time for a 2-week free trial to Market Insights. On Monday, June 24th, Tom O'Brien closed out all 5 open positions in his daily newsletter Market Insights, with all trades being profitable and ranging from a 2.23% gain all the way to more than an 11% gain in just one position, for an incredible 32.7% profit combined between the 5 trades. Let Tom O'Brien's years of market experience work for you. If you'd like to see for yourself what kind of trading newsletter Tom O'Brien delivers to his clients each morning, then now is a perfect time to sign up for a 2-week free trial to his daily newsletter, Market Insights. In a volatile market like we currently have, the potential for fast market moves like we've seen recently is a trader's dream. So don't wait any longer. Sign up for your 2-week free trial to Market Insights today at the front page of TFNN.com.
This segment is brought to you by Harmony Gold. For more information, just click the Harmony Gold banner on the front page of TFNN.com.
Tom O'Brien.
Welcome back to the Tom O'Brien Show, folks. I'm your guest host, Steve Rhodes, filling in for Tom on this 4th of July special edition, and thanks so much for joining us. I wanted to say thank you to Michael, Susan, another Michael, Sally, and Dave. They're the most recent folks that have signed up for Mastering Probability. Folks, you too can get in on it. It's a 4th of July special that we are running here. You can test drive my newsletter service, Mastering Probability, 2 weeks, absolutely free, no charge to your credit card or anything. Doesn't matter whether you had signed up for my newsletter service in the past or not. So go over to the homepage of TFNN.com. Don't let time slip by. Do it while you're near a computer right now. You can even do it from your smartphone or your pad or what have you. So that's all the details on the homepage of TFNN.com. You'll see underneath breaking news, you will see a link for a free trial Mastering Probability. So you want to take advantage of that before that gets removed from the TFNN homepage out here. You know, we spent some time taking a look at the ETF structure inside the SPYs, inside the we took a look at the weekly charts, the SPYs, the Qs, the IWM, and the diamonds. Let's go actually into the S&P 500, the sectors inside here, and take a look at the same type of charts, the weekly charts. And let's start off with the financial sector. If we take a look at, that's the XLF. If we take a look at the financial sector, it too, traveling with inside its rising price channel out here. What we can see here is right now, I'm taking a look at coming back to the November 16th low inside the XLF. That level is 1506. You're at 1940 right now. And your next touch point could really be, and take a look at a trend line, could be that April 19th level. That's where we saw a change in trend in the marketplace. That's where we saw a swing point on the daily charts. And so 1775 would be it. You can see that that is a trend line. That trend line was tested last week. It held the week of June 28th. Looks like we've got the XLF headed back there. If we see it close below that trend line, that is going to set up a move down to the next trend line, which is coming off of the October 14th low. That price point being $10.95, the week of October 7th, I should say, which is $10.95. And you can use as your next touch point that June 8th low right at about $13.30, and that's that red line that is out there. If we take a look at retracements and what that would be, just simply coming off of November 16th all the way up to the high that was put in here May 22nd, probably what you're looking at is about $17.34-ish or so. And if that level gets broken, what the XLF will do is travel all the way down to the bottom of the rising price channel. So right now it's up against some good support. You want to be paying attention to those trend lines out there, because if it breaks, it helps you understand where the next levels of support, or could be resistance. In this case here, we're going to say the next level of support. That is on the XLF. If we take a look at the XLK, this one gets kind of interesting. And the reason, again, we're looking at a weekly chart, gets interesting because we're taking a look at the rising price channel coming off of the 2009 lows. And what we can see here last week, so this would be almost more of a little bit of a bullish, but yet still we want to take a look at the bearish case as well, because last week we saw a test of the bottom of that rising price channel, the week of June 28th, as it got down to $29.94. That level held. If we see a break of that, this will be the first time we would see a break of that rising price channel going all the way back to August of 2011 out there, and that would be serious. Now, it doesn't mean that it can't break it and get back inside there, but the XLK has got more of a bullish look to it than it does a bearish look at this stage until that rising price channel gets broken. Now, the key here is to understand that the XLK, in the technology sector, is the largest weighting structure within inside the S&P 500. So that means it's very important to be watching this, just as it's important to be watching the financial sector as well. If we go take a look at the next sector out here, let's look at energy, although I think energy is sector number 5 or 6, 4, 5, or 6 here from a weighting standpoint. It used to be higher than that. And now as we take a look at the energy sector, what you can see here, traveling to the midpoint of the rising price channel here. But what it's also doing, if we come back off of the lows here from June of 2012, was really June 4th, but it would be the week here of June 8th, that low, 61.11. Your next touch points could be either the November 23rd low. That was a key swing point, so that's a good one to use, 69.74. Also, the January 4th level, we saw a move up in January 2nd, so you could use that touch point as well, 69.57. We can see that area, that trend line, was tested back here in April of 2013. That held. It was tested last week, and it held. If, in fact, this trend line breaks, what will happen inside the energy sector? It will likely move all the way back down to the bottom of its rising price channel. Price area target probably around 72 and some change out there. But right now, it's holding, but you still want to be paying attention to this because this will help you to understand trends that would be breaking, significant trends, because, of course, we're looking at a weekly chart inside the sectors inside the S&P 500. Let's go take a look at the consumer staples sector here, the XLP. The XLP rose above the rising price channel. That's not a breakout because price was moving higher anyways. A breakout would be, or in this case here, would have to break down to the downside. This is, again, coming off of March 2009. But we can see it broke out of that rising price channel and got back inside it. Boy, you get back inside it, it says, you know what? Maybe what we'll do is just go pay a visit to the downside, to the bottom here. But right now it looks okay. If this breaks the swing point here from June 28th, that low is 38.87. That will be our signal that the consumer staples sector wants to take a little breather and head all the way back down to the low, which could be maybe around the 37.50-ish type range inside the XLP. If we go take a look at the let's go take a look at the XLV. And the XLV, oh no, it just escaped my mind. No, I can figure this out here. The XLV, is that the health sector? That is, yeah, the health sector out here. And if we take a look at the health sector, now this broke through its rising price channel. All that it did last week is come back down and test that level. So this is really still a bullish looking chart out here. And if this breaks back inside that level, that's when you can start to see a move all the way back down towards the bottom. So that is on the healthcare sector. Let's go take a look at the utilities. The utility sector, that has been a struggle. And if you're wondering, here is where the utility sector broke out of the rising price channel. Did it most recently here the week of April 26th. Got back inside it. Once it got back inside, what it did was it took a quick visit all the way back down to the bottom. Now, it's bullish from the standpoint, long term, that it came back and it tested on June 21st. It got down to a low of 35.80. And what it did was it tested the bottom of that rising price channel. Now it looks like this week here that we're seeing that it wants to move back down into that area as well. But these are the sectors, or some of the sectors, not all of them, with inside the S&P 500. Folks, it is the end of our session out here, and I want you to, you and your family, everybody, have a safe and happy 4th of July. We'll be back with you live on Monday morning. Remember, go test drive Mastering Probability. Be a great time to spend over the next couple of days, and certainly over the weekend. I'll look forward to seeing you on Monday morning, and what I want you to remember is this: you have an amazing power within yourself, and that power is so strong it'll create a life of abundance. It'll cure incurable diseases, build billion-dollar businesses, paint magnificent masterpieces, but most of all, folks, create fantastic, loving families. Thanks so much for being a part of the TFNN family. Have a great holiday. We'll look forward to seeing you soon. Take care, folks.